FedEx shares jumping right now after beating on earnings, so there was a miss on the top line. Let's bring in Evercore ISI's Jonathan Chappell. He has an outperforming $327 price target on FedEx. It's good to have you on right now. I'm wondering what's sending shares so much higher right now. Is it the fact that the FedEx Express operating results improved, maybe signaling an inflection for that business, which means so much to FedEx? Or is this really about the full year guidance in which they've narrowed the EPS range? Capital expenditures are going to be a little bit lower than prior guidance, and they've reaffirmed revenue decline in the low single-digit percentages year on year, so not any worse than feared. What's driving the move?
Yeah, it's almost expressly all the former. No pun intended. But Express was the big focus of this earnings release. It disappointed back in December. There was a lot of hand-wringing. Could Express margins go negative in this fiscal third quarter? You know, how low could it get? There were some weather events in January and December, which was really spooking the stock back in February. To have this margin come in at 2.5%, which is not only a full 150 basis points better than street expectations, but is actually up sequentially about 80 basis points, which is counter-seasonal. I think that's the main focus here. And really what's important about it is it's not even so much a read on the macro, which I'm sure we'll talk about at some point, but it's really more FedEx specific. They continue to execute on their drive initiatives to take structural costs out, and to have a beat of this magnitude on the Express margin, I think that's driving the entire upside in the stock today.
Yeah, and I realize FedEx has had a lot of company-specific stuff that it's working through over these last however many quarters, and yet we're seeing shares of UPS trade up in sympathy right now. And I wonder how it speaks to the macro environment that both of these companies are navigating at a time where, yes, the margins are looking better in Express, cost cuts continue, and you're seeing those in the results here, but you're still seeing top-line declines.
Yeah, you're exactly right, Morgan. I mean, the revenue did miss in every single segment. The macro doesn't look great at this time of the cycle. You know, we've done a lot of pre-quiet period discussions with all of our companies across all the different segments of freight, and it doesn't sound great out there right now. So I'm a little bit surprised by the sympathy move by UPS today. Of course, it's only 2%, but UPS has their investor day next week, so we'll see what they have to say about the demand side. And of course, the FedEx call doesn't start for another hour, so I think there'll be a lot of questions around the macro and the demand and volume environment as well, not just in the U.S., but also in Europe and Asia.
Is it more about that on the call, Jonathan? Are there also questions about the sustainability of this margin improvement and the success, this near-term success in Express, which so many were worried about?
Well, it really is both, but I think the latter for FedEx is most important. We still have to see the execution of this drive initiative. It's supposed to be $1.8 billion in cost this fiscal year, $2.2 billion next fiscal year. So as Morgan said at the start, narrowing the guidance range with the midpoint being exactly the same point, I think helps, but really proof that they can execute on that $2.2 billion, which admittedly is probably harder to attain than the lower hanging fruit of the $1.8 billion. That's going to be most important to the FedEx story specifically. But if they do give a positive on the macro, which I'd be a little bit surprised if they did, then I could understand, in sympathy moves by UPS and other freight surface transportation stocks as well.